Now let's go to option 2. This is actually really cool. Exit strategy number 2 for this property. We're going to increase NOI. We're going to do a cash out refi, and then we're going to hold. All right. So here's the difference. Now we're still going to do the same. We're going to increase the NOI by increasing the rents. We're going to convert the garage into a 1-1 or 2-1 and then rent it out, and we're going to stabilize it. Now, once we do that, actually here, let's analyze the cash flow on this property first for this step, okay? Now, if you're looking at the chart, purchase price $410, you go through the chart, turnkey cost is $94,300, current income is $3,000, okay, $3,084. I like to do calculations on a monthly basis first, and then I convert them into annualized figures, okay? So you take the current monthly income of $3,084, you subtract debt service, $2,437. It's a little bit high because, again, this is a short-term hard money loan. Does that make sense? We subtract $2,437 a month, you subtract tax, subtract insurance, property management, utilities, you have a net of negative $237, which is equivalent to negative CCR of 3.02%. Now, one of my rules, it's almost like a law for me, is to do not buy negative cash flow properties. Okay, do not, it's a no. Why am I doing it for this property? I've done this project so much, I've done it so many times, and this project have a decent upside. I have the confidence, I have the resources to do this, but if I were a new investor, I would never do this, okay? Because number one, it's violating one of my laws of investment, the negative cash flow, okay? Never be a negative cash flow. This is exception, again, because of my resources and my expertise, right? Now, if you look on the right side of the charts, look on right next to Rehab as a $30,000. So now what is the difference? Instead of just the turnkey cost, now your total cash expenditure have to add that $30,000 to do the calculations. Make sense? And then you do the same thing, pro forma incomes after we have increased the rents, after we built out the units. So now, instead of $3,084 a month, we're at $4,700 a month. And you use that $4,700, subtract all of the expenses, and then at the very end, our net is now $908 a month, which is equivalent to 8.77% cash on cash return, okay? It's still, I mean, those figures aren't very impressive, but here's the thing. Here's the next step. This is step 2 of exit strategy number 2. Step 2, we're going to do something called cash out refi. Because we increased NOI, now we can go back to the bank and tell them, hey, this property is now worth more money. Does that make sense? Banks will allow you to do a cash out refi if they deem that the property value is now higher. If we systematically increase the rents, we forcibly increase the value of the property. Make sense? Now it's just a matter of whether or not this bank sees the value as you see the value. So the banks will generally send out people to evaluate the property, and still, based on $525,000 of sale price, the bank will say, okay, well, if this property is worth $525,000, they will finance up to 80%. Make sense? And so we can do a cash out of $131,000 on this property, which will net us $6,950 based on a $525,000 valuation. Okay. Now, the cash out is $131,250, and the reason the cash out is $131,250 is because property is valued at $525,000. 75% of that is $393,000. Okay, as you guys can see on the figures, your cash out portion is $131, but remember your total cash expenditure, correct? When you take the cash out portion and then you minus what you have put in for the total cash expenditure, your net is $6,950. Make sense? But here's the thing. I now have a property. I now have taken all of the money out in which I put in initially, and I still have $6,950 left over. Now, I still have this property though, okay? So let's keep on looking at the numbers. Pro forma income on a monthly basis, $4,700. We subtract the new debt service number. Now the bank's financing us, presumably 5.5% 30-year fixed, okay? Now the payment actually dropped from $2,400 to $2,236, all right? And we keep on using that $4,700 to subtract the expenses, taxes, insurance, property management, utility, 5% vacancy, 5% maintenance. We have a net of $1,002 a month, okay? That's $12,000 a year. And if you guys look at the CCR, cash on cash return, you can't really calculate the cash on cash return because at this point it's infinite cash on cash return. I have $0 in this property, okay? And it's continuing to generate us $12,000 a year. You tell me how much money that is worth. Make sense? So this strategy is very cool because you get all your money back. At the same time, you still have a property is appreciating. You still have a positive cash flowing property, which is a great way to do things. If you're trying to build up your wealth, this is one of the ways to do it.